Recently, I was watching a podcast interview with Jaspreet Singh, the founder of the Minority Mindset channel, at Minority Mindset. And during that conversation, the host asked him a very direct question. What happens to the U.S. economy as trillions of dollars move through the great wealth transfer, especially after the latest estate tax changes? Jaspreet's response wasn't emotional, it wasn't political, and it wasn't speculative. It was focused on one thing: how money moves and how investors need to understand that movement. And that question stuck with me, because right now, America is quietly entering one of the largest financial transitions it has ever seen. Under the current estate tax structure, a significant amount of wealth can now pass from one generation to the next without triggering federal estate taxes. And at the same time, more than trillions of dollars are expected to change hands over the next 20 years. And when money moves at that scale, spending changes, investment behavior changes, and opportunity shifts. This video is not about repeating that podcast, and it's not about copying anyone's words. It's about breaking down the idea behind the answer and understanding how an investor can think clearly, strategically, and responsibly inside today's economic reality. Because the real advantage doesn't come from headlines, it comes from understanding where money is going next. One of the most important things to understand about the great wealth transfer is that money doesn't just move, behavior moves with it. And this is something Jaspreet Singh often highlights indirectly when he talks about mindset, psychology, and how people treat money they didn't personally earn. Because here's the reality. Younger generations spend money very differently than the generation that built that wealth. Baby boomers, for the most part, grew up valuing saving, long-term ownership, and delayed gratification. But when that same money reaches millennials, Gen X, and Gen Z, the priorities start to shift. Not because one group is right or wrong, but because life experiences are different. This is where the idea of generational spending cycles comes in. Often, the first generation builds the wealth, the second generation protects it, and the third generation tends to spend it faster. Not always, but often enough that history keeps repeating it. Why? Because the most expensive type of money is money you didn't have to work for. When people receive money through inheritance, they're statistically more likely to spend it. Not because they're irresponsible, but because that money doesn't carry the same emotional weight. And when spending increases, the economy feels it. You see it in consumer demand, you see it in travel, luxury goods, technology, services, and everyday spending. Another key factor here is real estate. A massive portion of transferred wealth comes in the form of homes. On paper, that sounds incredible. A paid-off house, passed down, worth hundreds of thousands or even millions of dollars. But ownership comes with ongoing costs. Property taxes rise as home values rise. Insurance costs increase. Maintenance doesn't stop. And for many heirs, especially younger ones, those costs can become overwhelming, which means more homes get sold. And when homes get sold, that turns assets into cash. And when cash appears, spending usually follows. So now zoom out for a second. You have trillions of dollars moving, a growing portion of that money becoming liquid, and a generation that is more comfortable spending than sitting on idle wealth. That combination doesn't slow the economy down. It changes where money flows. And this is where investors start paying attention, because spending doesn't disappear. It transfers value. Every dollar spent ends up in someone else's hands. And more often than not, it ends up with the owners of assets. Now, once spending patterns start changing, the next thing that changes is how people invest. Because younger generations don't look at investing the same way older generations did. Baby boomers, for the most part, followed a very traditional approach. Stocks, bonds, retirement accounts, long-term holding. That strategy worked well for decades. But millennials, Gen X, and Gen Z grew up in a very different environment. They lived through market crashes, housing crises, high inflation periods, and rapid technological change. So naturally, their investment behavior looks different. Instead of just stocks and bonds, you now see interest spread across technology, startups, digital assets, commodities, private investments, and alternative asset classes. This doesn't mean traditional investing is disappearing. It means capital is diversifying, and that matters. Because when trillions of dollars move into the hands of people who invest differently, demand begins to shift. And in investing, price always follows supply and demand. When more buyers show up for an asset, prices rise. When fewer buyers show up, prices stall or fall. So as inherited money begins flowing into newer asset categories, some markets see more attention, more capital, and more volatility. This is why understanding where money is moving is more important than chasing headlines. Another major shift here is accessibility. Investing today is easier than ever. You don't need to be wealthy. You don't need insider access. You don't need a Wall Street background. With ETFs, index funds, and fractional investing, people can own a piece of the broader economy with relatively small amounts of capital, and that changes participation. More participants means more capital flowing into markets, especially during periods of increased spending and liquidity. Now here's the key mindset shift. The people who benefit the most from this transition are not the ones guessing which stock will explode next. They're the ones who understand that when money moves through the economy, it always ends up rewarding asset ownership. When consumers spend more, business revenue increases. When revenue increases, company valuations respond. And when valuations respond, investors feel it first. This is not about predicting the future perfectly. It's about positioning intelligently inside a system where capital is already in motion. And right now, that system is being fueled by one of the largest wealth transfers in history. So when you zoom out and look at the bigger picture, this isn't just about inheritance, and it's not about politics. It's about understanding how money moves during the largest wealth shift America has ever seen. As discussed on the podcast with Jaspreet Singh, the people who benefit long-term are the ones who think like investors, not just earners. You don't need a massive inheritance. You don't need perfect timing. You need awareness, discipline, and a long-term mindset. Because when spending increases and capital flows through the economy, asset owners are the ones positioned to benefit. If this helped you see the system more clearly, share this video with someone who needs it, subscribe for more investor-focused education, and start paying attention to where money is moving, not just where it's been. That's how the minority mindset thinks.